You think you make logical decisions with your money. The data suggests otherwise. Let's run the numbers. Consider the default options automatically selected for your retirement accounts and subscriptions. Most employees accept the pre-selected contribution rate on their new retirement plans without making any adjustments. This choice occurs because reviewing alternative rates requires navigating complex administrative steps. These pre-selected financial paths are formally called defaults. In many cases, these settings remain active for years, quietly shaping how much money you save and invest without your direct intervention. Why do we allow these pre-selected choices to guide our long-term financial future so easily? The answer lies in how our minds handle complex decisions in structured environments. We tend to assume that defaults are official recommendations designed by experts for our direct benefit. This assumption often prevents us from investigating if a better investment alternative is available. In reality, defaults are simply path of least resistance settings. They are selected because they are easy for the provider to implement, not because they align with your specific financial goals. This behavioral pattern becomes clear when we look at how individuals manage their workplace savings plans. A default contribution rate can act as a long-term trap for your hard-earned money. When employees enroll automatically, they are often placed into a low contribution rate. While this rate is better than saving nothing, it remains highly insufficient for long-term retirement planning. This low contribution rate becomes a baseline that people accept indefinitely. They rarely increase their savings manually, even when their household income allows them to make larger contributions easily. This passive behavior results in a significant savings gap over time. The individual misses the compounding growth that a higher contribution rate would have generated in their investment account. Similarly, default investment allocations often place savings into conservative funds. These funds prioritize preserving capital but offer much lower historical returns than typical diversified equity investment options over the long run. By leaving savings in the default fund, investors may protect themselves from short-term market changes, but they reduce the long-term purchasing power of their total accumulated retirement funds. To understand why defaults are so powerful, we must look closely at the concept of inertia. In physics, inertia keeps a resting object completely still until an external force acts. In behavioral finance, decision inertia operates the exact same way. A consumer continues with an active setup because changing it requires a conscious decision and a direct physical action. Every change to a financial plan requires navigating friction. You must locate account credentials, review alternative options, and complete multiple step validation processes on various digital service platforms. This friction acts as a clear psychological cost. When faced with even small administrative hurdles, our minds often postpone the task, allowing the default setting to remain active indefinitely. This delay is not a simple failure of willpower. It reflects bounded rationality, where individuals prioritize immediate cognitive demands over complex long-term calculations about their future financial outcomes. Furthermore, defaults are closely tied to status quo bias. This behavioral bias is the tendency to perceive the current state of affairs as a reference point or baseline. Any deviation from this baseline is often evaluated as a potential loss. This psychological framing can make the alternative choice feel riskier, even when the evidence supports it. By framing the default as the safe or normal option, choice architects can guide consumer decisions. This mechanism works because it matches our natural behavioral tendency to avoid losses. Now, let us examine the causal mechanism. In any choice environment, the way options are presented is called choice architecture. There is no such thing as a neutral design. Every sign-up process, bank application, or insurance portal must present options in some sequence. Whichever option is pre-selected as the default gains an immediate and highly substantial advantage. One primary reason is cognitive ease. Accepting the default option requires zero decisions, zero form filling, and zero active comparison of interest rates, fee structures, or complex investment risks. For busy individuals, this cognitive ease is highly attractive. When a decision is complex, our cognitive load increases, making us much more likely to accept the pre-selected option. Another key factor is the implied endorsement. Many consumers interpret the pre-selected default option as the recommended or standard path established by their trusted service provider in almost all scenarios. This perceived recommendation builds trust. The customer assumes that because the company handles thousands of accounts, the default setting must represent a suitable choice for most account users. However, this assumption is often incorrect. Providers design defaults to meet their operational needs, reduce support costs, or satisfy regulatory requirements, not to optimize your personal wealth over time. This mechanism is very clear in modern subscription services. Auto-renewal settings ensure that the subscription remains active, even when the customer has stopped using the service entirely for months. The provider leverages inertia to maintain revenue. By requiring active cancellation steps, they introduce friction that causes many consumers to delay ending the subscription indefinitely and avoid immediate effort. Under these conditions, small recurring charges continue month after month. Each individual charge seems minor, but their cumulative annual cost can be highly substantial for a household budget. This pattern highlights the difference between opt-in and opt-out structures. In an opt-in system, you must actively choose to participate. In opt-out systems, participation is always the default option. Opt-out structures lead to significantly higher participation rates. While this structure is effective for increasing enrollment, it reduces the probability that users choose rates matching their actual needs. This friction is amplified when alternative choices are not presented clearly. If finding information requires multiple digital clicks, consumers are much less likely to explore other settings or rates. The design of the choice environment can shift behavior without restricting choice. By making one path the default, providers steer decisions while maintaining the appearance of individual freedom. This influence works quietly because consumers rarely notice the choice architecture. They assume their decision to accept the default was entirely self-directed and personally optimal in the end. To evaluate defaults fairly, we must consider the boundary conditions. Under some specific conditions, default options are highly beneficial, especially when individuals lack any specialized financial knowledge or experience. For these individuals, researching every investment detail would create severe decision fatigue. An automated default setting can protect them from making costly errors in complex financial systems they do not understand. Furthermore, automatic enrollment defaults have successfully increased overall retirement savings rates across populations. In this context, defaults act as a helpful and essential tool for personal wealth accumulation. However, defaults are not a universal solution. An option that works well for a high-income saver might be inappropriate for a household facing immediate and severe liquidity constraints. Forcing these households into savings defaults can reduce their available cash for essential expenses. This outcome highlights the risk of using a single pre-selected rate for every saver. In addition, defaults can create moral hazard. The provider might set defaults that favor their own commercial interests, relying on consumer inertia to prevent subsequent changes from occurring. Under these conditions, defaults function as a soft tax on inattention. Without active monitoring, the pre-selected options may divert customer assets into higher fee investment products over the years. This insight resolves our opening question. We accept suboptimal defaults not because we are lazy, but because the choice environment is deliberately designed to leverage our natural inertia. When a task requires cognitive effort, our minds automatically seek the path of least resistance. The default option provides that easy path, offering immediate and effortless ease in the moment. To counter this effect, we must recognize that pre-selected settings are choices made on our behalf. They are not recommendations tailored to our specific financial circumstances or long-term goals. By understanding this mechanism, we can shift our relationship with defaults. We can treat them as assumptions that require validation rather than established optimal financial settings for our accounts. This shifts the burden of proof back to the default setting. The question becomes whether the default aligns with your actual goals, rather than why you should change settings. This adjustment changes our behavior. When we view defaults as choices that need audit, we are more willing to navigate the small administrative frictions required to change them permanently. The intervention does not require constant effort. It requires a one-time setup adjustment that aligns defaults with your target savings, investment allocations, or digital subscription preferences in the future. By shifting defaults once, you leverage inertia in your favor. Once the target option is set as the default, Inertia helps you maintain that savings path automatically over time. This mechanism is the core of choice engineering. Instead of fighting decision friction every day, you design a choice environment that supports your long-term plans by default setting. To apply this concept, consider a structural audit. Identify all default financial configurations currently active in your bank accounts, workplace retirement savings, and digital subscription services. Write down the contribution rates and fund choices. By listing these settings physically, you bring the choice environment into focus, reducing the salience of the pre-selected default. Next, evaluate if these active default setups meet your goals. If they fall short, schedule a specific time to navigate the administrative steps required to adjust them. Prepare for the administrative friction in advance. Set aside the necessary credentials and document details so that you can complete the change without leaving the process unfinished. For savings plans, consider using automated escalation features. These settings automatically increase your savings rate annually, leveraging inertia to grow your assets over time. For digital subscriptions, review auto-renew defaults immediately after registration. Changing these options early ensures that you must actively opt in to continue the service when it renews. This simple change alters the choice framework. Instead of paying for a service you do not use, you are forced to make a fresh judgment when the term expires. These adjustments help you build a more disciplined environment. By making target choices the default path, you reduce the day-to-day willpower required to sustain your financial plan. The pre-selected settings around you are design choices, not recommendations. Inspect the choice architecture. Don't fight your brain, engineer your environment. See you next time.